All right. Well, welcome everyone. We're gonna, I'm sure, have some people trickling in as the noon o'clock hour has just struck. So it is time to begin. And to be fair to all of you, because I do tend to be long-winded when it comes to these presentations, I will get started. Couple of housekeeping things right off the bat. There is in Zoom a Q&A function. So if you would like to type a question, it can be kept private, so it doesn't have to be shared with the group. It can be, sent just to us with what your question is, or you can share it with everyone, and I can either answer it live or we can follow up with it afterward. Certainly, if it's a question specific to you and your account, and I'm going to encourage everybody at the end of this to set up a time to just talk with us, because even if there's no changes that need to be made, it's always good to talk. That there'll be time for that at the end, or after this we can set up a one-on-one. But a little bit of housekeeping. For those of you who may not know me, and most of you would, but my name is Anthony Gerbi. I'm a financial advisor and the head of analytics here at Stein Financial Group, and I'm going to be taking you through the state of the markets. We recently just had the State of the Union. This is meant to be sort of a corollary, but with less maybe aspirational talking and more kind of grounded, factual. Where are we? Where have we been? Where might we be going? That sort of thing. And hopefully I'll get to some of the questions that you have as well as we go through here. Final disclaimer, I'm going to click through to our disclosures as I talk about it. This has nothing to do with the presentation other than if you catch me occasionally squinting at the screen or up at the bigger screen that's in front of me, it's because I had an eye exam this morning and they dilated my pupils. So I'm on the recovery from that, but it's still a little hazy as it gets when your pupils are dilated. So if you catch me kind of just double checking what's up, it says that's why. It's not because my eyes are going bad. It's just the regular course of things. So this is also going to be recorded. So we will have a replay of this sent out to all of you, and it will be on our YouTube channel, which if you didn't know we had a YouTube channel, it's a great place to look us up, Stein Financial Group. If you just search that in YouTube, you'll come up with us. And I do video every week. There's lots of there's replays of all our past events. You can go back and watch this event from years past and see how accurate we were with some of our thoughts. Last year, not as accurate. You'll see nobody was really accurate when it came to predicting things last year. But anyway, that's my plug. So a little more information about me. I'll put this back up on the screen again for the couple of you who maybe don't know me already. This is all of our contact info, mine specifically, but also our group. So don't hesitate to get in touch. So I've got a lot of information to go through. I'm going to do it as quickly as possible, or as efficiently as possible, I'll say. But there will be some slides that have a lot of data on them. And when I go through those slides with a lot of data, I may not go into every minute detail that each slide goes into. That's by design. If I did, this would take 2 hours, 3 hours, it would be a whole course. So there's going to be plenty of information that you might want to drill deeper on. Again, feel free to reach out with those questions, either via the Q&A, the chat, or just afterwards, one-on-one. So I talked about it a little bit. Our agenda is fairly straightforward. How did stocks perform in 2022? What drove market performance in 2022? And where are we now? All those things are things that we're going to cover here. And I'm going to advance the next slide here so we can get started. So how did things go in 2022? Well, I don't think it's going to shock any of you that things did not go particularly well for the stock market in 2022. And this isn't going to make you feel better, but basically, and I'll move my head so you can see where everybody else thought we would be. Everybody thought last year was going to be a fairly decent year, and it was not by any stretch of the imagination. We had Morgan Stanley, UBS, Wells Fargo, Bank of America, and RBC all make their predictions at the start of the year for where the S&P 500, which are the 500 largest stocks in the stock market, where that would end up for the year. Where did we end up? Well, you can see the number kind of off my other way. That shoulder, 3839. Don't worry about what that number means. It's just where do we compare to where we started the year. That was down about 20% in the stock market last year. Nobody among these major firms predicted a drop like that last year. Now, there were a couple extenuating circumstances. There was the Russia-Ukraine situation, which is still ongoing. Inflation became a much bigger problem much quicker. We'll kind of go over what happened and why that affected things so much, and more importantly, where things are going from here. But most everybody thought last year was going to be pretty decent in terms of the market, and most everybody was dead wrong on that point for multiple reasons, not just for one reason. To kind of quickly digress, there's kind of a story. If you've had a meeting with me recently, I may have used this kind of parable to explain what's going on. But the way I've been talking about last year, and it's specifically when it comes to investments and how do we manage our way through a year that's down almost 20% in the stock market, is I use this story. And the story is, a lot of us, myself included, have had a time in our lives where something health-wise has been not quite right. Maybe hopefully nothing serious, but something's not right, and you go into the doctor because you want him to take a look at it, and you say, something's wrong. I don't know what it is. I'm worried it might be this or that, or I haven't thought about it at all. I just know something's wrong. And the doctor takes a look at you, and they sit down and they maybe run a few tests, do some blood work, and everything comes back pretty much normal. And they then tell you, I think the best thing you could do right now is to go home, get some rest, drink lots of water, and maybe I've got a few stretches for you, or I've got this or that little home remedy you can try. And you sit there and you walk out of the doctor's office because they send you home, and you say, well, I'm relieved that the doctor doesn't think that this is a big deal. I don't want there to be anything wrong. It wouldn't feel good if there was something major wrong. But a little part of you says, but I wish I had a better answer than that. And that's kind of what a lot of my meetings have been like with people over the last year. We look at what the market's doing. Obviously, it's not good. But the prescription for most people, in most cases, at least last year, and spoiler alert, continuing on to this year, is just kind of rest and drink water. Keep things the same, stay disciplined, stay invested. Things will come back. It will get better. That could be the right answer. And a lot of times it is. More times than not, I would argue it is. But it doesn't feel super satisfying. I get that. It feels like we should be able to walk in and make a change to adapt to the new situation. And in an ideal world, I think we would try to do that, or we would be able to do that. But in this world, the best course of action most of the time is going to be doing less, not doing more. Another way to sort of wrap that in a nutshell is there's a phrase in investing: a rising tide raises all boats, meaning when the market goes up, everybody does well for the most part, right? And everybody's different, of course, that's a generalization. But last year, the best way I can put it, a sinking tide or a tide going out lowers all boats. It lowers the boats that are the little dinghy in the harbor that is just a tiny little boat, and it lowers the super yacht anchored much more deeper. The whole tide went out last year. That's what we saw with the market, and that's why we're all in the situation we are now. It has less to do with the quality of the boat and more to do with the level of the tide. So thank you for indulging my kind of parables and metaphor stories here. But those are two ways that I've kind of described this past year in more, I guess, understandable terms. But we are going to get into the technical details. So for those of you who came for that, here we go. This is a chart of the S&P 500. So again, when I say the stock market, I'm using the S&P 500 as a proxy for the overall market. S&P 500 are the 500 largest companies in the US stock market. This is the graph from last year. And the most important thing you may notice is it starts on the left pretty high and it ends on the right a little lower, right? That's the downward trend that we saw last year. But there's a couple key factors I wanted to point out here in what happened last year and how they affected time that went on. The first and obviously most important one was we had this nice little run in June and July. Well, I've told people that run started basically the day I went on vacation. So I'm starting a little collection at the end of this call. If anyone wants to fund my next vacation so that the market goes up, I'm totally willing. I'll take one for the team there. Okay, I'm joking. That is not the most important thing that happened last year. Actually, one of the most important things is this January 12th, the CPI. Now, for those of you who maybe follow business news, that sounds like a familiar acronym. It stands for the Consumer Price Index, but what I want you to think about is inflation. CPI means inflation. It's how we measure inflation. So inflation rose by 7% YOY year over year. Again, a lot of acronyms here, meaning January 12th, inflation was 7% more, or prices were 7% higher than January of 2021 when they measured before. And actually, that's probably a December number, but you get the point. The fact that it was 7% is one thing, but it was much higher than was expected, much sooner than was expected. That set the tone for the year. We knew immediately, once the year started, that we were going to be dealing with higher inflation in 2022. Now, you might notice, what is our tool to fight inflation? Well, the biggest tool is the Federal Reserve raising interest rates. Now that, if you notice, the first interest rate rise didn't happen until March 16th of last year, a full 2 months after the inflation numbers came in. I think and I don't know if they'd admit this, but I think if the Federal Reserve could do last year over again, they would be more aggressive sooner with interest rates than they even were last year. And they ended up getting very aggressive with interest rates. My head is sort of hiding this, but in June and July, they reacted very strongly with interest rate increases. And that is part of where the volatility, by the way, for the market came from. But I think if they could go back in time, they would do this sooner, because basically what we've seen, and we'll get to a whole slide dedicated to inflation in just a little bit, but inflation peaked in this July period and has come down ever since then, even though the market's been up and down. So I think if they had reacted a little bit sooner, we might have gotten to, for example, this January we just had where the market was up pretty nicely. That might have happened sooner. So if I was going to nitpick on the strategy that the Fed has taken, I think they might have needed to start a little bit sooner than they did. But we see that inflation stayed high throughout the year. The Federal Reserve continues to raise interest rates. And the last thing I'm going to point out here is the first half of the year, the GDP of our economy shrunk in both the first quarter and the second quarter. July 30th and April 30th are the dates if you're looking for those numbers. GDP is a measure of our economy, not necessarily the stock market, although of course those two things are very interconnected. GDP stands for gross domestic product, and that just is a measure of how productive we are as an economy. It kind of tries to boil down an economy to one number, which is of course impossible, but you got to get it to a number at some point so you can tell whether you're going up or down. The first half of last year, the first two quarters, April 30th, July 30th, they're measuring the quarter that had just happened, were both negative. Now, I went to school for economics, not that long ago. And when I was in school for economics, there is a definition of what we would call a recession. And that definition classically is 2 consecutive quarters or half a year of negative economic growth measured by, in this case, GDP. Well, I just told you the first 2 quarters were negative. That means by classic definition, we were in a recession to start last year, the first half of last year. These things are always backwards looking, and I'll get to the second half of last year in a second. But one of the interesting things about economics in the world we live in right now is, in the US government's eyes, they now have a committee to determine whether we're in a recession or not. And they say they look at other factors, which, hey, I'm all for looking at all the factors you can. But I'm also all for calling a recession, even if it's a small recession, which is what it was. My opinion here, I think the government, and this is both parties, this is not a political thing, it's every politician has an interest in using the word recession as little as possible. And personally, I think that's a little bit of what's going on when they have a committee to kind of oversee whether it really is a recession or not. I go by the classic definition. Just, is it positive or is it negative for 2 quarters in a row? It was negative for 2 quarters in a row. It's a recession. So in my opinion, we had a recession last year. However, the good news is both the third quarter, you can see October 30th down there, and you don't see December 30th yet, but the third quarter and the fourth quarter, we have those numbers now. We're both positive. Well, just like 2 in a row negative gets you into a recession, 2 in a row positive gets you out of one. That doesn't mean we won't have another one this year. Some people have predicted that. We'll get into that in the second half when we go over predictions. But in terms of what I would call it from my, yes, I have a degree in economics, but I'm not the chairman of the Federal Reserve. I would say we had a recession last year and we also exited it in the same year, which is somewhat rare. But what that really speaks to is how shallow that recession really was. So this is maybe one of the most important slides because it really, there's a couple different stories you can tell with just a calendar from last year. This is looking backwards. I'll move out of the way so you can see a little better if I adjust my size here. One of the big drivers of the stock market, I'm not going to spend too much time on this, is corporate earnings. And as you can see, this is year over year growth, I should say, in corporate earnings. 2021 was a great year for corporate earnings, mostly because we were coming out of 2020, which was a terrible year for obvious reasons. We had the pandemic slow everything down. Now, going into the end of last year, earnings growth was going down, but was still positive. As we've entered this year, there's been a lot of chatter about whether that will stay the trend or whether growth will turn negative, and will that have negative consequences on the stock market. I'll tell you right now, the answer to that question has been very mixed. We'll get to that in a little bit, but I think the pessimists going into the year, the people who were really predicting a high certainty of recession, have been a little too pessimistic based on the numbers we've actually seen come in. So forget about even prognostication, just where have we been in January? The projections were a little too pessimistic, but we'll get there. So the economy, I already talked about GDP growth. One thing I can highlight here, our labor market, which when you see this number, this is unemployment rate, is still historically low. There's some more information I'll have in a couple slides on this, but we have many more jobs. In fact, it's almost 2 to 1 jobs available to people looking for jobs right now, even with where we stand today. So not even at the peak last summer, but even where we stand today. That is a good sign that our economy can sort of tighten without going into that full-scale recession. And that's really what the Federal Reserve is trying to help us do. We want to tighten things up so inflation is not such a big problem, because you can see Q2, 9.1% inflation, that is not sustainable. We cannot be there long term. So they're trying to fix that problem without making this unemployment rate go through the roof as well. And that's traditionally the balance they've had to try to strike. Well, the good news is, even though inflation is still too high, this actually January's numbers just came out and it was 6.4% inflation. So it's gone down even from the 7.1 you see on the screen here. Inflation has gone down for 7 months in a row since July. That's good. We still need it to go down more though, and that's the problem. One of the things you'll notice on here is housing, and it just gives a number, and you're like, what does that mean? Well, it's kind of an aggregate number that's assigned to how healthy the housing market is. And the lower number doesn't necessarily mean it's unhealthy, but it's not as active as it was before. This should surprise no one. The housing market has significantly slowed down. That's actually a good sign that inflation will be under control here pretty shortly, because housing can kind of front run regular inflation. I'm talking grocery store inflation, energy inflation. Housing is a good sign that we're on the right track there. But the housing market versus 12 months ago, almost a night and day difference. Anybody who's done a real estate transaction recently can speak to that. So I talked a lot about where we are now already, but let me throw even more confusing charts up on the screen. And that is, these are our speedometers These get released every month, actually, by a company called City National Rockdale. And partially, this is their opinion about where things are at. You'll notice geopolitical risk is one of these. Now, I don't want to mislead anybody. This is from November of 21. So this is not last year, but the year before, where we thought we would be going in 2022. And you can see why all those big firms on that first slide made their projections and thought we were going to be in the green last year. Everything looked pretty good, other than geopolitical risk was always a worry. Obviously, that became a bigger worry as time went on. But this is where we are in December of 22. And you're going to look, and the thing you should take away from this is there's a lot more red on this screen, isn't there, than there was last year. Now, last year, to go back, just because there's a lot of green doesn't mean the market's going to do well. Just because there's a lot of red doesn't necessarily mean the market's going to do poorly. However, I would very much agree with City National Rockdale, who puts out this this chart every month. We have a lot of challenges. Look at the stuff that's in the red, for example, geopolitical risk. Not only is the Russia-Ukraine conflict still ongoing, and that poses a problem both on the price side of things, with food and energy being major disruptions because of that conflict, but also just the geopolitical risk in general by potential escalation or potential dragging on of the conflict. I mean, I'm not a military expert, but we've talked about this a lot in the last year of all the different ways this could go. But add on to that the new tension with China, that in the past week, with this spy balloon that was taken down off the coast of South Carolina, one of the Carolinas, North Carolina, after it passed over the whole US. And now all of these other things that they're picking up out of the sky, which who knows exactly what they are. They haven't quite told us yet. But at the very least, this is going to be an increase in tension between us and China, purely because of the first spy balloon, if not pending what those other ones are. That could be a headwind, and I think will be a headwind for us as the year goes on. We haven't had this full direct confrontation with China in terms of economics since really the previous presidency, when then we had that trade war, which is, you know, it's not really over. We've just kind of took a break because the pandemic changed all our priorities for a little bit. At some point, that will heat up again. And it remains to be seen what sort of deals will be cut, trade deals, import-export balance, all that stuff is up in the air. That's why the risk is towards the red there. I won't go through each one of these like this, but I will say most of the other red dials have something to do with either interest rates or inflation. And that's the problem that we see. Most of the other stuff is mixed right now. And by the way, that would be my point, my take-home point from this. I think there is a lot of pessimism out there, publicly, but even in the industry. So I'm not even speaking of public pessimism. I think there's a lot of industry folks who are predicting a recession this year, who are predicting a very volatile market this year. And I wouldn't say that they're wrong. I think those things could happen. But I also think that the data is much more mixed than their pessimistic view would allow for. And I'm by no means an unabashed optimist. I'm maybe more optimistic than they are, but I definitely believe the market will be choppy this year. I have very little doubts about that. And, you know, take that with a grain of salt as you would with anybody. I don't know the future, but the data we've gotten so far to lead me to that conclusion is more mixed than I think people have been saying on pick your favorite cable news organization or your favorite website where you might read news. Or if you don't do that, and you're probably healthier for it, the places I read the news anyway, because that's part of my job. So it's more mixed than I think a lot of people are leading us to believe, at least people with mouthpieces who speak publicly. This is a chart of, it's kind of an amalgamation of a bunch of different indicators. And you could go up and look at what all these are. It deals with inflation, it deals with employment, it deals with housing, it deals with manufacturing. I won't define the whole thing here, but more or less, this chart was created to try to do what people have been trying to do for centuries, if not longer, which is figure out what's going to happen before it happens. I'll tell you right now, this is not a perfect science. It's not even close to perfect. No one's been able to crack that code. And if they did, they'd be very rich at this point. But this is sort of the best guess that we can have about leading economic indicators. What's going to happen tomorrow? Leading indicators are usually things that start to happen before the overall economy or market moves. So you want to watch those closely to try to get a sense of where the market's going to go. And you might notice that on the very far right of this screen, it's dipped into the negative area. Now, negative, positive, that doesn't correlate. That doesn't mean it's predicting the market's going to go down necessarily. But when the leading indicators go negative, these shaded regions tend to pop up, and those are recessions. So 2020 is the most recent. Notice they don't have the 2022 that I would call a recession because it wasn't officially termed a recession. That semantics at this point, but we have 08, 09, and if I move my head, we have 01, 02. So those are our last three, I guess, major recessions, I would call it. And every time this has gone negative, save for 2016, 17, there's been a recession shortly after. So this chart is of some value. And I would say that the fact that this portion over on the right-hand side is negative means we probably are in for a choppy year. That doesn't necessarily, in my opinion, mean we're headed for a recession, but it does indicate a choppy year will still be ahead for the stock market. There will be some better news as I go to the projections part of this for the bond market, which is not necessarily what I've been talking about so far, but this year especially, it's important to make a distinction between those two. Before I get there, what are our headwinds? Meaning, what is blowing against us? What's going to stop us from making progress? Inflation is the number one thing. You might expect me to say geopolitical tensions is the number one thing. Not that that's not important. I don't want to minimize that. Inflation, in my opinion, is still the biggest threat to the economy and to the market. And threat might sound a little dark. I'm not saying it's going to stop us in our tracks, but it's the biggest headwind is a good term for it. Inflation is, shame on me for not going into deep. We've talked about inflation. You've heard that word so many times in the last year. I forget to define it at the start here. Inflation is just an increase in prices over time. It's a name for that phenomenon. Sometimes I think, I know that this industry gets way too jargon heavy. And I should do a better job of defining things, even though I know a lot of us have talked about inflation in the past. So rising prices are our biggest headwind. Food prices, energy prices, home prices for a long time, although that maybe corrected itself sooner rather than later. But that is what the Federal Reserve has to get under control. And that's where you see the second bullet point, the Fed policy. We are not sure exactly how far the Fed is going to have to go to get inflation under control. We think we have a pretty good idea, actually. There's a lot of projections, and we think we're actually the majority of the way there to getting the vast majority of the way there to getting inflation under control. But it doesn't happen overnight is the problem. We've seen inflation come down for 7 straight months, but it's not to where we need it to be yet. So we need to continue to let it come down. The issue now is, how do we continue to make inflation come down without overdoing it and really slamming on the brakes or pulling the e-brake on the economy? That's what the Federal Reserve is trying not to do. They're trying to, those of you who drove cars before anti-lock brakes were a thing will remember when you are on an icy road, you have to pump the brakes to make sure your wheels don't lock up. The Fed is trying to pump the brakes right now instead of just jamming and sliding off the road. That's what we're trying to avoid. A recession could be on the horizon. I hope I come off as a little bit more optimistic than that, because that's what I really am. But a recession is not unrealistic this year, which I know maybe sounds like I'm hedging my bets a little bit. And honestly, I've trained as an economist. Maybe I am hedging my bets, but that is a realistic possibility. So I don't want to minimize it. Corporate earnings, I said there's been a lot of mixed results there. I'm not going to do a full technical analysis of earnings. And then geopolitical tensions, which at this point, I talked about them a little bit. They kind of speak for themselves. What are our tailwinds, though? What are the things that are working in our favor this year? So moderating inflation. Moderating is a good word because it is going down, but it's not to where we need it yet. We need it to continue to decrease over time. We just had an inflation report this past week, by the way, that was a little bit higher than expected still. So even though it's coming down, we still have to make sure it gets all the way down to where we want it to, preferably around 2%. I think if the Fed could get it to 4%, they'd be pretty happy. But long term, we want it closer to 2%. A more dovish Fed, all that really means is they're probably not going to have to increase interest rates at the same clip they did last year, which is good because that was one thing that really disrupted and caused a lot of uncertainty for the market, linking it back to our actual topic today. The interest rate cycle, just draw a line straight from that to a more dovish Fed. Those things are tied together significantly. One thing, two things I'll mention on the international front. One of the issues with investing that had nothing, well, I shouldn't say that had nothing to do, was mostly separate from a lot of the things that went on last year, was the US dollar appreciated like crazy last year. If any of you took an international trip, you probably did very well, no matter where you went, because the US dollar appreciated relative to pretty much every currency in the world last year, to varying degrees, of course. That is not necessarily good or bad in of itself. The problem is for any of us, as most of us do, who have some international investments, that makes our return look lower. And the simplest way is if I'm a company like Unilever, which makes deodorant that's sold on our shelves but is based in Europe. When you sell products in Europe, you're making money in euros or in the UK pounds or you're making money in your local currency. When that gets translated back to US investors, it translates into dollars. And if a euro buys fewer dollars than it did a year ago, it looks like they made less money than they actually did, even if they sold the same amount of stuff. That hurts our profits. Now, on the flip side, going ahead, it looks like the US dollar is not going to crater or anything like that, but may depreciate relative to some other currencies this year. That could actually do the opposite effect. It could make international returns look better. So instead of being a negative, it could actually be a positive. It's probably more technical detail than you want, but hey, I am who I am. And finally, China ending their lockdown was seen as a very important step for the global economy. Now that we have this whole tension with the spy balloon, we'll see where US-China relations actually go. I think it's a tailwind for sure for them to end their lockdown, economically speaking, but I don't know where that's actually going to go policy or trade-wise yet. Nobody does, not even the two governments themselves, China and the US, know exactly what's going to happen yet. And this is a measure of, is the stock market overpriced or underpriced? You're going to see PE ratio. That stands for price to earnings ratio. All you need to do when you hear that is, what is the stock market's price per stock relative to what it's been in the past? And what we're trying to gather from this is, are things overpriced or are they underpriced? And what I want you to notice is, I moved my head right to the wrong spot. In 2020, on the right hand of this graph, things were very overpriced relative to history. I'm not saying it was wrongly priced. I'm saying just relative to history, things were overpriced. There are obvious reasons for that. We had a ton of stimulus coming out of the pandemic. Things really caught on fire in 2020 after the pandemic hit. It's not surprising the stock market was overpriced. Now, with last year's, drop down in the market, things are actually reasonably priced going forward. And in fact, we are under, in terms of our average price per stock, the long-term 25-year average. What does that mean? Well, long-term things tend to revert to this middle line. Stocks tend to be average price because that's what the definition of average is. So you could argue that this slide is showing us that actually stocks could go up in price, meaning go up in value, over the next couple of years to revert to the mean. This is not a hard and fast rule. There's no guarantee that that happens. But if we're talking about things to look at, that's one of the things that most people want to look at. I'm going to go through this one pretty quickly. One of the things, so when the more pessimistic people on the news or wherever start talking about the economy, this is one thing that doesn't get talked about very much, which is, as opposed to 2007, 2008, or really almost any time in the US history, if not world history, we are in a better position as a country, individuals I'm speaking of, to weather a choppier economic environment. That is a very broad statement. economic uncertainty is bad because it hurts people. People can lose their jobs, so I don't want to minimize the individual impacts. But in the aggregate, what this chart on the right is showing is that we have, as individuals in this country, this is not the US government that this is tracking, this is us as people combined together, have between 1.5 and $2 trillion of excess savings with which to work with during this time. I'm not, here to talk about the conversation about where that money is concentrated, because obviously there are plenty of people who are still struggling. This is not me saying, wow, look at how good we all are. There are lots of people who are not doing well financially. But in terms of where we're at relative to where we've been historically, we are in a better position for economic choppiness than we have ever been in as a country in our history. That doesn't mean economic choppiness is good. It doesn't mean it's good. Oh, it's all going to be fine because we have all this extra savings. But it is going to help that we have that extra savings. And you might be looking at and saying, wow, I'd like some of that savings. Can I get some of that extra savings? I could use some more of that. Fair enough. But just know that we are in a healthier position from that standpoint than I think a lot of people have admitted or publicly stated. Just my 2 cents there. Inflation and interest rates. This is really important for one reason. The question we all need to be asking ourselves in terms of the stock market, in terms of the bond market is, are we done with interest rate increases? I'm going to give you my answer right now. I do not think we're done. We had one in January. The Fed raised interest rates in January by 1/4 percentage point. I think there will be another interest rate raise in the spring. At this point, if I had to guess, I would say 1/4 point, but it's kind of too soon to tell with that. They'll need more inflation data to make that decision. If it keeps going down like it has, it'll probably be 1/4 point. If it sort of levels off and doesn't go down as much, they might have to go up to 1/2. But what this chart is showing is a bunch of traders on the stock market were surveyed about where they think the interest rates will be at the end of this year. Or excuse me, for the June 14th, halfway through this year, not for the end of this year. And most people think it will be between 4.75% and 5%. This is called the Fed funds rate. I'm not going to go into what that is. Just think of it as the general interest rate that the Fed is adjusting. When you see 4.75, that's just 4.75%. There's a lot of weird technical jargon here that I wish was presented in a better way, but that's just how we talk about these things. And you just kind of have to know. I'm here to interpret that for you. The point is, we are currently today, I Googled this morning, just get the live number. We are at 458 on this chart. So 4.58%. If they think we're going to be between 4.75 and 5 by halfway through this year, that says we're probably going to have either a 0.25 or a 0.5% interest rate increase. The take home point from this, that is not a lot. Last year, we had multiple instances where interest rates went up by 0.75 percentage point back-to-back months, right? So in first half of the year, raising rates by 1/4 point to 1/2 point, that's not that much. And that's good for the overall economy, and it's good for bonds, which is a key piece that I'll talk about in just a minute. But bonds this year, as opposed to stocks, where I definitely think stocks will be choppy this year, bonds have a much better outlook. In fact, one of their best outlooks in years. No guarantees, of course, but one of their bonds may have the best year since probably the 2009 time period. That a lot of people are predicting that anyway, when they bounce back in 2008. What are we projecting for economic growth? So here's the forward-looking part of my talk today. First off, very good news. Unemployment on the right here is expected to go up. That's not good necessarily, but it's not expected to go up by that much. And that is key. That goes back to my brake pumping analogy. That means we, as the projections of unemployment are a good indication that we are going to successfully pump the brakes and come to a slowdown versus locking them and sliding off the road. There's no guarantees of any of this, but the fact that the unemployment rate might go up, but only by a little bit, is a good sign for the economy, because that means things are tightening, but they're not over tightening to the point where we actually contract. And that's kind of the game we have to play, or that the Fed is playing. And secondly, GDP. So real GDP, well, what isn't all GDP real? Why would they have a non-real GDP? That's just a weird jargony term to mean gross domestic product after inflation is baked in. So in other words, is our economy going to grow in 2023, or is it going to shrink, i.e. have a recession? Well, currently, the best projections are we think we're just going to avoid a recession. We think Q1, it's going to be close, but will probably be positive in terms of economic growth. Q2, same story. It'll be close, but will be positive. And Q3, things should start getting a little better. With Q4, maybe we're back to kind of where we were before the pandemic, which was about 2 to 3% growth a year. This is still in flux. There's still a lot of data to be gathered before this can be certain, but these are good numbers. Notice there are no negatives on the GDP side, right? Negatives are what we would need for there to be a recession. So as of today, we are not predicting a recession. Some people are. Me personally, I am not predicting a recession, but it's close. Just like last year was close and tipped, in my opinion, over into recession. Excuse me. I'm going to point out one thing here. Don't worry about those slides on the right. If you're watching this on the recording, feel free to pause and read what they are and have your eyes glaze over, just like every Economics 101 student when they have to look at these charts. What I want to show you is labor demand. What this chart on the left is showing is the ratio of job openings to job seekers. And this goes back to the same conversation about tightening without shrinking or collapsing, which is we currently, currently, this is a little bit old because all these numbers are backwards looking. July, August, we had 1.87 jobs open per worker, per job seeker in this country. Why is that important? Well, it's obviously important because the labor market has been tight. Nobody's been able to find enough workers. We all know that, right? But what that means is we can shrink the economy is not really the way I would put it. We can shrink the job market. Some jobs can go away and we will still have more jobs than workers in this country. Now, not all jobs are created equal. I'm not here to tell you that somebody working at a gas station is going to make the same amount of money as somebody working in the C-suite for a Fortune 500 company. That's some of the higher end jobs might be cut, some of the lower end jobs might stay. So you got to take that into account when you look at this. But it's better to have it where we're at now than to have it the opposite problem where there's 2 workers for every open job. That's when things can really get tight and get bad more quickly. So compare where we are today, June, August of 22, to where we were in 2008, for example. We had about 0.7 job openings for every worker. We had less job openings than workers. We are in a better position, is my point in bringing this up, to weather the volatility than we have been for almost any period since, this goes back to the 70s here, labor market speaking. Again, this is just one data point. It doesn't prove anything, but it adds up with the other data points. I hesitate to even show you this. I don't care about these numbers, and neither should you, because I showed you the chart earlier where all these same firms predicted what 2022 was going to do, and they were all dead wrong, right? This is their prediction for 2023. I don't care what their predictions are. It's not that I don't care, but I don't take this to the bank at all. I'm not looking at it and saying, well, Goldman Sachs seems to know what they're doing, and they think it's going to get to 3,600, which, by the way, would be a decrease from where we are today. So, batten down the hatches, it's going to be a bad year. Or, wow, UBS, they're predicting a pretty decent year this year, so I'm going to believe them. I'm not putting stock into any of these. What this gives you is, I think, a backup to the point that I made earlier, which is there's a sense of pessimism out there that is earned in a lot of ways, but isn't the full view. I think a lot of this stuff is maybe a little bit over pessimistic when it comes to where things are going. We just had news. I think it was JP Morgan. They had predicted, the CEO of JP Morgan famously, the fourth part of last year, came out and said, we really think 2023 is going to be a tough year. We are predicting a recession. on down the line. And then one of their senior analysts recently, I think this was JP Morgan, came out and said, actually, things are a little bit better than we thought. And that was kind of the point that I was making in the fourth quarter of last year, which is the numbers are coming in a little more mixed than the dour predictions that a lot of people were having. So take that with what you will. Now, here I'm going to talk about bonds for a little bit, and then I'm going to wrap up. And if there's time, if anyone has questions, we'll take them then, and we'll get you out of here by 1 at the latest. This is what a 60-40 portfolio, I'll move my head out of the way so you can see all the numbers here, has done for the past, well, since 1977. Okay, what is a 60-40 portfolio? Well, portfolio. That means 60% of the investment is in the stock market, and 40% are in bonds. And I've hinted at bonds this whole way through. So bonds are the purple part of this. Stocks are the blue part. Notice last year, besides the fact that it's a big down, right? Notice that both the purple and the blue were down last year. Now, if you go back and look at any other year throughout this whole timeline since 1977, there is no other year where both stocks and bonds were down, save 2018, that is, which was basically that year was flat. It was down just very slightly. That, not just the fact that the stock market was down, was a negative last year. Bonds were down significantly more than what they're down in a year when the market's down like this. Look at 2008, for example. The stock market was down more, much more than last year, but bonds were slightly up. Why didn't that happen last year? Well, the reason, it's very simple, is interest rates. I've used this example before. I won't go through. Bonds can get very complicated very quickly, but let me try to do this as quickly and as efficiently as I can. A bond is a loan. Many of you, most of you on this call, if not all of you, have bonds as part of your investments. And a bond is a loan, and in a lot of cases, not for all of you, but for the majority of you, for the majority of your account, your loans are to the federal US government. All right? So you've loaned them money. They've agreed to pay you back that loan on a certain day in the future, and they're going to pay you interest for your trouble all the way through. That's plain and simple what a bond is. Think of it like a CD at the banks. It's very similar. Not quite the same, but similar. Now, why do rising interest rates hurt bonds? Why do they make bond values go down? It's simple, hopefully, if I can make it simple. If I have a bond that I've loaned my $100 to the US government, and they're paying me 2% interest, which would have been pretty good a year ago at this point. And all of a sudden, they raise interest rates and say, hey, we're going to issue all new bonds. You can give us your $100 and we'll pay you 4% interest. If I wanted to sell you my bond, where you could just go out to the US government and buy a brand new one, I'd have to give you a discount. Why would you take my 2% versus their 4% when you're going to get paid back the same amount at the end anyway? That's why bond values have gone down. Now, by the same token, and this is where bonds are very different than stocks, bonds have an end date baked in. I said that right at the beginning, right? They mature at a certain point is the technical term for it, where you get your $100 back. As time goes on, these bonds that were down, that purple part is down, are going to mature and get paid back at par value. If you're a golfer, you know what par value means. It's even. You get paid back, not up, but not down either. So as time goes on, bonds are automatically going to start recovering their losses because they're getting closer to their maturity date. There's another good thing to look forward to this year as far as bonds go, though, and that's we've taken our lumps as far as interest rates have gone. I still think, as I said, rates will go up a little bit this year, but not nearly as much as they went up last year. And why that's important is we took our lumps last year. That was not fun. I'm not saying that was a good thing. But now that we have, there are bonds out there that are yielding 4, 5, 6%. And it's not quite a return to the 1980s where you could get a CD at the bank for 15% a year and just retire on that. But it's much closer to that than where we've been in the 2010s, let's say, where interest rates were at the floor basically the whole time. So you can now get 5, 6, 7% interest on bonds and get some of that appreciation back from what we lost last year. So this year, the way I've described it, it's going to, even if the market is choppy, it's going to feel night and day different than last year did, purely because the bonds are projected. And again, there's no certainty here as far as what the interest rates are going to do. There is certainty where the bonds will mature. So there is some certainty there, but that can get complicated quickly. This year is going to feel so much better because the bonds are most likely going to do so much better than they did last year. They won't be a negative, and they could be a very significant positive. Now, don't expect your bonds to make 20 or 30% like a good year in the market would be. That I highly doubt is going to happen. But by the end of the year, could bonds be between 5 and 10% on the upside? Yeah, very easily they could be with what we're seeing from the data right now. That would be a night and day shift from last year and would be a great benefit to a choppy market. It'll make the choppy market feel much less choppy, is kind of my point in bringing this up. So there are no guarantees. There are no guarantees in life. The closest thing to a risk-free investment these days is a US government bond, by the way. Those are considered to be risk-free. One of the things that's going to be upcoming as I wrap up here is the US is going to talk about the debt ceiling and whether we need to raise it. And let me make this as clear as I can. Both parties in Congress know that the debt ceiling has to be raised. There is no other good option. It is not a good decision for the US to not raise the debt ceiling. You might be saying, I've heard about this debt ceiling, Anthony. What does it mean? I won't get into all the details, but basically what it means is we have to be allowed as a country to take out more debt to finance the debt that we already have. So it's not about racking up new bills necessarily. It's just about paying the people off that we've already taken the debt out from because interest rates have gone up and that's gotten more expensive. Anyway, not doing so. I get if you're saying, hey, more debt, that doesn't sound very good, Anthony. Why would we want more of that? It's not that we want more debt, but we have to fulfill the obligations we've already done. The consequences for not doing that is way more uncertainty in the bond market, way more uncertainty in the stock market, and it's bad for everybody if we don't raise the debt ceiling. I expect a lot of politicking and hand-wringing about what's going to be attached to the debt ceiling raising. Both parties, they're going to haggle over it right to the last minute, which is not how I'd prefer it be done. But that's what I expect to happen. But both parties know that it is a huge mistake at this point to not raise the debt ceiling. And so I do expect it to be raised, but there will be probably May, June, a time period where it is the number one issue that you hear about on the news every night. And you're constantly getting feeds into the House floor where people are arguing about it back and forth and what they're going to attach to it. That's just the political reality we live in. That's a politics thing. I do expect the debt ceiling to be raised. And whether that's a good thing or a bad thing, it's a necessary thing. And we have to deal with the consequences of having debt later on down the road. I wish I had a better answer than that, but that's kind of just how it is. It's a reality of our economic situation. I'm going to wrap up and then we'll have a few minutes for questions. Your steps to take. Keep us informed. Tell us about your concerns and make sure your documents are up to date. And Kim or Aaron actually is putting a bunch of links in the chat right now to our YouTube channel, to our website, where we have lots of great information, lots of replays of other really informative topics that you can view and we think are a really great value. One thing I'm going to add on to this really quick, steps for you to take. If we have not talked in a handful of months, let's say, put some time on my calendar. You can just do it right from our website. You can go, hey, I want to make an appointment. It's being linked in the chat right now. You can just pick a time on my calendar that works for you, and we'll sit down and talk. And even if the answer is, as I alluded to at the beginning, go home, drink some water, rest, it'll be okay. it's better that we talked about it than that we just let it stew, especially if you're concerned about things. So I'm going to encourage everybody on here to do that if we haven't talked in a little while. For us to take, keep you informed, manage your investments according to you. I do not believe in a one-size-fits-all investment strategy. And not only do I not believe in it, I don't think anybody should believe in it. You are an individual who has different needs than someone else does. And your investments should fit you, not fit some other version of someone else who did a good job. It's about you. It's not about what your neighbor's doing. And for us to take, we'll give you more events like this where we present what's going on and give you our unfiltered, honest take on it. I do want to say one quick thing, which is if you try to book time with me in particular, there will be a period in early March where I'm not going to be very available. And the reason for that is my wife and I are expecting our first child in the first week of March. And if everything goes according to schedule, it will be that first week of March. That's the due date. So we're very excited. Everything's been going great. It's fantastic. But I hope you'll understand that's why I might not be as reachable in March, and certainly not in person right away either. It'll be mostly virtual if you can reach me in that part of the year. So that's my personal disclaimer. The whole rest of the team is available. So, that shouldn't stop you, but just know if you're like, hey, Anthony, you told me to book some time, but you don't seem very available. That's why. And a reminder from Kim, as people are dropping off here, this is not just a great time to look at your accounts. It's actually a great time to look at your plan too. So the overarching piece about how much can I spend, what's my retirement plan look like, all that stuff. That's another thing that we should be taking a look at regularly. We do that, but this is another good time to do that. So that's another thing to get in touch with us about if you haven't spoken to us in the past couple months. And honestly, even if you have in the past couple months, it's a great time to just re-up everything. So Bill has a question about something called an inverted yield curve, which is a technical term. And the important part about it is that an inverted yield curve means a yield curve, not to get overly technical here, is the longer a bond has until it's due, usually the higher interest rate you get for it, right? So if you take a 30 years to get paid back, you get a higher interest rate than something that pays you back in 6 months. And what happens when that scale inverts, where you actually get a higher interest rate for a shorter term bond than a longer term one? Traditionally, that has been an indication that people are pessimistic about the economy in the short term. And you'll hear it on the news, oh, the yield curve inverted today, we might be in for a recession in the next 6 months or a year. Historically, a recession does somewhat follow an inverted yield curve, but not right away and not always. You'll see people, well, a recession has always followed an inverted yield curve, and that's just because recessions happen with somewhat regular intervals. And so they're always, going to follow an inverted yield curve. But for example, the yield curve, Bill, inverted in, I think, late 06, early 07 for the 2008 recession. And everything was, well, debatably fine for the next 9 to 18 months. And then 2008 happened. So in some ways, it can be an indicator, but it's not a perfect indicator, is my opinion. I think the yield curve stuff is a little overblown. It's sort of a simple talking point that the news likes to bring up, but doesn't mean as much as they would like it to mean. And then another question, effect of all the people coming into our country. And by that, I would take it to mean immigration, most likely illegal immigration. And, one of the things that's happening because of immigration, legal and illegal, is obviously we don't want illegal immigration. By definition, it's illegal, but the influx of people into our country is actually extremely important in the long run. We want it to be done the right way. So, politically, I'm not speaking about that, but I showed you that slide where there were 2 jobs, or 1.78 or whatever it was, jobs per person. searching for a job in our country, we need more workers. And if you look at a country like Japan, for example, or where China is going to be in 10 years, they don't have a population that can sustain the amount of jobs in their economy. We need immigration. We need, don't get me wrong, we need legal immigration, but we need it in a high quantity to sustain the economy that we do have. So in general, illegal immigration is not a good thing, but it does have other facets of it that can be positive. At least legal immigration does. So we want to try to turn as much illegal immigration into legal immigration. Without getting too political, that's the sort of economic answer that I would give you. So we're at 1:03. I want to respect everybody's time, so I think we'll stop it there. But if you had more questions that I didn't get to, again, please reach out and we can do one-on-one to answer them. So thank you so much, everybody, for being here. I hope it was a good use of your time. I really enjoyed doing it, and we'll see you next time. Thanks.